So hello, Rumi. Nice to be talking with you on ESG information for the data section of the PIMFA ESG Academy. This one being a course for wealth managers. So let's focus on how this really plays out with the wealth managers, if that's okay. So my first question. ESG funds, we've all seen there's been a massive explosion in growth of them. And I understand that MSCI is saying it's something like 200 billion inflows over the last year. I estimate with my figures that I hold for the UK market something like 80 billion assets under management now in UK retail funds. That's gone up tenfold since I was first doing this. And what I'd like to get to, if we can, is just drilling down into what some of those figures mean, where you're seeing the activity, and you've got the index-based strategies and the active strategies and the geographic areas. There's so much variation in this space. Perhaps you could tell me a bit more about how you break that down at MSCI.
Sure, Julia. So, I mean, we're seeing that globally just over $3 trillion currently sits within funds with some form of sustainable investing mandate, and this could be deep ESG integration or just basic sort of screens. So you're applying quite a liberal net to what constitutes as ESG, from basic screens all the way to deeper integration. It's just over $3 trillion across active, passives, and so forth. The majority of these assets, over 80%, still lies in active mutual funds, whilst the remainder is ETFs and index funds. Equity funds historically have been the dominant segment in this area, accounting for over 55% as of the end of last year. But we are now beginning to see some proliferation of ESG fixed income, as well as other asset classes as well. I'd say the pace of product growth has been faster in ETFs, whilst the pace and index products, whilst the pace of ESG integration into existing funds has been faster in mutual funds. Also, what's very noticeable is, as of the end of last year, Europe has led the world in the availability of ESG funds and the pace of product launches, with over 50% of global ESG ETFs, for example, being domiciled in Europe. European investors also show quite a clear preference towards values and screens-based approaches, whereas investors sort of other side of the Atlantic in the US have more of a preference towards integration and thematic products. One thing that's also, I think, mention worthy is where once ESG funds came with quite a fee premium, this, I think, is starting to shift, particularly in Europe, where we are now witnessing fees compression, making ESG funds increasingly aligned with their non-ESG peers. And finally, liquidity has also developed substantially in this space, in particular through ETFs, as a result of both primary and secondary market activity.
Would you like to expand a little bit more on that, on the liquidity point?
Sure, yes. So as you can imagine, when a fund is launched in the first instance, it's not really heavily traded. So there might be quite a spread to pay in buying units of that fund. But over time, as those funds grow and market makers and sort of market participants become more familiar with that product, the spread naturally comes down. So this is something that was perhaps an issue with a lot of ESG funds when they first emerged in Europe. But now increasingly, ESG funds that have been around for 2, 3, 5 years, they've reached a good level of liquidity now, such that trading them doesn't incur any significant spread difference versus trading a non-ESG counterpart.
I'm interested, though, some of what you were saying there is picking up on where people are based who are actually making these investments. Do you have any feel for the geographic regions that UK wealth managers are focusing on buying? Would you say there are areas of the world that they favour? Is that something you can talk on?
One thing that's quite noticeable is, most ESG funds, for example, if you look at the top 20 largest ESG funds globally, right, you'll find that most of them are actually domiciled in Europe. But if you look at the geographic focus of those funds, you'll find that the focus of most of those funds, in fact, over 12, I think, is actually the US. So there's kind of a sort of opposites there. Europe domiciled, European investors, but really the main focus of these ESG funds is US ESG or US SRI or US thematic. And I think part of the reason is just because of the size of the US in terms of relative size as a market. And that isn't just the case in ESG, just in normal sort of fund investing, you'll find that the largest segment of funds are US equity funds. And so that translates to ESG as well, where because of the size of it that it takes in an investor portfolio, it's where the most optionality and where most of the focus is.
We certainly see that there's a lot of innovation going on in the States in this area. And perhaps it's being under-recognised by other people in the States, whereas a lot of UK-based investors would tend to have quite substantial investments in the States and the States and Europe, and then the rest of the world is kind of trailing quite often a little bit. But that's interesting.
I think just maybe the final, I thought that Europe's ESG charge has mainly been driven by policy and investor shifts in attitude, so sort of supernatural policy developments, things like Paris Accord. These kind of things have driven growth and demand in these products, as European sort of regulators have put sustainability at the heart of a lot of new legislation. So that's encouraged a lot of growth in these funds. We are in the early stages of sort of seeing that shift in the US. So I expect a similar trajectory will follow in the States in the coming years.
Yes, I think you're absolutely right, and I very much hope the States comes on board also. There's a lot more to come from the FCA as well. In fact, by the time these videos are live, I would like to think that things like the principles will be up and running. There's a lot happening there. So yes, absolutely, the role of regulators and the response to societal issues that are driving the need for change, I think, are absolutely central to all the messaging on all of these funds. And being able to pick your winners because they've got good strategies that align to societal and environmental changes that we need to respond to, I think is super important. Rumi, one of the comments that over the years has been thrown at this area, shall we say, is talking about likely underperformance because of ESG, sustainable, ethical, whatever strategies. I almost can't believe I'm having to ask this question, but I know some people do still feel like this. So if you can, I'd like to hear it from you, sort of putting it to bed, hopefully, that around whether or not investors have to sacrifice performance. So could you tell me the MSCI view on that, please? Do investors have to sacrifice performance in this area?
Sure. So, part of it depends on investment horizon, as with any investment performance analysis. But as an example, if we take the MSCI All Country World Index as representative of global equity since the end of 2007, we find that stocks with a higher ESG rating have outperformed the wider market, not only on an absolute basis, but also on a risk-adjusted basis with a higher Sharpe ratio. So, alongside that, our research also showed that ESG leaders in general have shown resilience in times of crisis. So again, another example, MSCI ESG indexes outperformed the wider all-country index, for example, during the peak of the pandemic last year. And have also demonstrated a stronger performance in the longer term. So, and this is transcended from issuers to ESG funds in general as well. I think it's also worth mentioning that for many investors, it isn't purely about performance. I think that's the common assumption, that the first thing we should talk about is performance. Values alignment is actually what's more important to them. So, for example, this year, in the early part of the year, we saw a slight outperformance in a lot of value sectors such as oil and gas and utilities, and that's purely through rotational movements, as those sort of underperformed last year. But a lot of ESG investors, of course, missed out on those sectors because they didn't invest in them from a values-based perspective. So for them, being fossil fuel free or low carbon intensity, and thereby missing out on a rebound in energy and utilities or whatever sector it may be, that's a conscious decision for them. It's not really something that they would consider as performance sacrifice in the conventional sense, because their first lens of selection in the universe it's a values-based approach.
Yes, they've made a conscious decision that they don't want to invest in those areas. And quite possibly for the reason that they recognise that if a company is not run with a good eye on sustainability issues, then there's every chance that they're going to be in a sector that is inherently unsustainable. Yes, this is about looking for better companies and more forward-looking companies. But what about talking about ESG as a proxy for good management, for well-run companies as a whole? Is that a line that MSCI takes also?
Yes, absolutely. I mean, the MSCI approach to ESG is all about financial materiality. So within a given sector or industry group, which ESG issues are most material for their operations. As you can imagine, let's say an oil and gas company with a lot of operations offshore, for them, environmental and physical risks might be more prevalent than let's say, a bank operating on the high street that doesn't experience typhoons or whatever. So it's about appropriately weighting ESG risks that are financially material depending on which sector or industry group a company operates in. And to your point, yes, it's not just about excluding sectors and not being invested in certain areas. It's also about the overall management of ESG risks, and that also feeds into sort of outperformance as well. It's difficult to argue why a company that has proper mitigation measures and proper considerations against financially material risks would not outperform their peers. That's something we've extensively published on and sort of demonstrated that it does provide longer term outperformance.
So you're talking about oil and gas and the way those companies are run, but obviously their product is inherently unsustainable, although if we're talking plastics, hugely valuable and not about to go away. But you've also got those banks that are financing them, and those companies will hit real trouble at some point as well. Do you look into that? Do you research whether or not the banks are requiring net zero of the companies that they're lending to, or net zero plans from the companies? Because I know this is something that the PRA and the regulators are increasingly talking about. Does that come through in your data?
It's something we look at issuer level research. I think the broader thing to bear in mind when it comes to sectors that might currently have a predominant high footprint, it's what they're doing as well, right? So we, within a given industry, we'll look at which companies are actually taking measures to become less carbon intensive. So if we take oil and gas, for example, you'll notice there's a cohort of companies that are actively doing a lot to actually become carbon neutral, shift their businesses to more renewable sources of power, investing a lot of R&D into researching new, more efficient ways of powering the world. So if we take the current snapshot, it's very easy to judge them and say, okay, well, oil and gas dirty and so forth. But I think it's important to take a forward-looking approach as well.
Absolutely. So, and that's where stewardship strategies come in, of course, and
Correct.
Responsible ownership. And,
yes.
There's one thing, DPSG integration, which I kind of call the foundation to this area. But then the top layer, if you think of it as kind of being a bit of a sandwich, the top layer has got to be responsible ownership and driving change that way. So my next question then, Rumi, is about the sources of ESG fund information, ratings and classifications that are available to wealth managers today. Now, of course, those people watching this video, I would hope, would already be familiar with my website, which is Fund Eco Market, part of the SRI Services sites that where we split funds into their different styles. But obviously, that's not the only system that's available. Would you like to talk to that area and explain other sources, please?
Sure. So there's a lot of ESG sort of data sources out there. The main ones are independent ESG data providers, such as MSCI, Bloomberg, and so forth. ESG-related information can also be directly obtained from various company disclosures. However, that can require trained analyst collation and assessments. The main source for wealth managers, I think, are primarily the independent data providers who effectively are doing that task of company by company or fund by fund or whatever investment vehicle by vehicle data collection and analysis, and at the end providing aggregate ESG ratings, ESG indexes or ESG analytics, as well as other various risk and performance assessments.
We know the FCA is working on this at the moment, so it will be a little bit of a fool's game to try and second guess what they're trying to do. But do you have a classification system that you use on MSCI?
So MSCI offers multiple classification systems.
So a wealth manager could bespoke it to what their client was looking for, is that?
Correct, yes. Yes. So, for example, if the client is specifically interested in, let's say, UN Sustainable Development Goals, there's a module to assess the universe of investments through that. If they're particularly invested in, let's say, the new EU SFDR principal adverse indicators, there's a module to screen and look at the universe of investments through that, and EU taxonomy and so forth, and various other impact lenses. So it's very much modules available depending on what's of interest for that portfolio.
So Rumi, what factors do you think a wealth manager ought to be considering when they're using ESG research tools?
Sure. So first and foremost, I think it's important to consider coverage, not just in terms of issuers, the number of companies the data provider is covering, asset classes, methodological coverage. As you can imagine, different types of investments would require different kinds of treatments. So for example, a fund would require a different treatment to an investment trust, to a company, to a short position, to derivatives, and so forth. So do they have, coverage for different types of vehicles in the portfolio, ease of access, customization depending on reporting needs, breadth of data sets as well. As you can imagine, there's a lot of different lenses through which investors can choose. Can implement ESG view, policy-related data sets such as EU taxonomy, SFDR, and so forth, as well as impact-related data sets such as SDGs or and so forth. So a combination of all those things, I think, needs to inform the end decision in terms of which data provider someone should go for. Some might have very simple needs in terms of aggregate ratings reporting. Some might need more detailed, granular reporting, and so I'd say a combination of those is what really should inform the decision.
Cool. So that to me really talks to a wealth manager being able to set out their stall as doing a particular thing, and then having using different data dependent on how they've positioned themselves. And I think that level of variety is really, really valuable in the market, particularly for wealth managers. If you're trying to do something if you're dealing with ultra high net worth people, they may want something very specific. So I think that's really useful. So another debate that rages endlessly is the active versus passive debate. You and I have both been questioned on this regularly by people. So I guess my view to some extent is that I come from an active background where you make really careful stock selection decisions and you engage with companies and you do everything you can to make sure that the company is doing exactly what it says it does and moving in the right direction of travel. And I understand and have a massive affection for and respect for that approach. But I would also say that active managers need to have their activities complemented by passive managers. Otherwise, if passive people are pulling in the opposite direction, then they will get outvoted and you land up with all sorts of trouble. So we want everyone to be on board and doing a lot more in this area, I would say. So all comers are welcome. Would you like to expand on the line that you tend to take, and also perhaps explain whether or not you think ESG can actively be passive? Does it make sense at all?
Sure. So I think there's a need for both. It's not, in my mind, it isn't really a view of active versus passive. Both can complement each other and both can and do coexist in a lot of portfolios. I think the common view some people hold is that, with passive investments, because the objective is to track an index, that the absence of consequence, that because the investor can't divest, sell, and walk away, that therefore there's an absence of impact. And that's not necessarily true. The fund managers that manage, passive mandates, they do engage, on the shareholder behalfs with the companies. In fact, they're some of the biggest engagers globally out there when it comes to a lot of voting and decision making. So there is engagement, and there is sort of the argument that, in fact, by staying invested and not necessarily not being able to divest, you have a seat at the table every year when it comes to having a say. And in terms of long-term influence and long-term stewardship, it's a lot more impactful than simply divesting. It's a stick that I think sort of a lot of people think just active managers have, that because you can divest, you can walk away, there's a consequence, but that doesn't actually necessarily change how the company's operating long-term, whereas having a seat at the table year on year can have an impact. There's also the idea that because you're not doing stock selection yourself, how can you really make ESG decisions versus picking an ESG index? And fact of the matter there is, a lot of institutional stock selection quality tools actually inform the construction of a lot of ESG indexes. Sort of they're systematic, rules-based, they're transparent, and that's something that sort of is more easily in reach through, I would say, index investments than trying to figure out what the proprietary approach is that a independent active manager might implement in their ESG stock selection process. The levels of transparency, I think, are slightly different. I'm not saying one is better than the other. I'm just saying someone who wants it a bit more transparent might choose one over the other. That's my overall answer. That both can coexist, and there's some misnomers there.
Coming back to the largest funds that are in existence today, what a wealth manager who perhaps is just getting started in this area might, where they might perhaps start their journey. Can you give me a little bit of information on, what we're seeing in terms of the most popular funds in terms of size today? Are there any patterns that you can describe for us?
So we looked at the top 20 largest ESG funds globally as of the end of last year, and they held about $150 billion in assets. And they varied quite a lot in their approach. There's almost, I'd say, an equal split between index and active-based approaches, with a fair variety in fund type between both mutual funds, index funds, and ETFs. I think what was interesting last year in particular is that the order of size and the order of flows in the top 20 largest ESG funds was quite different. Active funds accounted for the lion's share of assets, holding over 50% of the AUM in the top 20 funds, whilst index-based strategies actually took in the lion's share of inflows, exceeding over $20 billion just in the top 20 largest ESG funds. And for example, one US focused ESG ETF alone took in over $7 billion in inflows. Thematic funds were also quite popular, have been popular as of late, namely clean energy, clean water in particular, which last year took in over I think $15 billion in inflows. The other, I think, noticeable sort of point is that sector exposures across ESG funds revealed that information technology was the largest exposure, followed by healthcare and communication services, and those were sectors that outperformed quite a bit last year. In terms of single holdings, Google was the most common stock held across most funds. Alphabet was in, I think, 12 funds out of the top 20, with an average weight of just under 2%. And in terms of sort of other companies with the highest average weighting across funds, again, there were tech companies. Apple and Microsoft were actually the most common companies with the highest holding weight, and collectively these two companies individually returned over 30 and 40% respectively in 2020, which again gives you an indication of their influence on a lot of ESG funds performance.
So that tells me we're looking at more the ESG side, the sort of risk mitigation side, and looking for investment opportunities going forward, rather than the deep dive into sustainability that we know so many UK-based investors want. I think it's going to be really interesting to see how this evolves over the next few years. We've seen this massive explosion of ESG, sustainability, responsible type funds over recent years, and that looks set to accelerate rather than slow down. Certainly the information I'm pulling together with my fund eco market stuff is that growth, this research in this area and research into funds is continuing to rise, which must mean future sales will go up, not down, presumably, if all other things being equal. But could you give us some pointers as to what you think the key things are wealth managers and the advisors who are working for those wealth management firms should be mindful of whilst they're talking about this area with their clients?
Sure. So, the main thing to be mindful of is the fact that the ESG Funds Universe is anything but uniform. And so if you just look at the top largest funds, it's very much a reflection of the spectrum of investor choice and preference, active, index-based, integration, values and screens, and thematics, and really highlight that there's no one way to invest sustainably. That different investors, really are at different stages of their ESG journey, and their preferences can be quite diverse. I think for index-based approaches to ESG, it's really important to have a good understanding of the index rules. Often the devil is in the index rules-based detail. For more active approaches, I think the rationale for holding a given name at times can be more subjective and driven by proprietary assessments by the fund manager, and the ESG integration approach can at times be less rules-based. So for those kind of funds, I think it's managing great engagement is critical with a thorough understanding of the prospectus and what the fund goals are. So alongside detailed prospectus and fund goal study, I think it's really important to engage with fund managers. I think the key message, however, is that a fund's ESG policy matters quite a bit, and it's important to be mindful of that for fair comparison. For example, you'll find there's half a dozen different UK equity funds out there that on the face of it might have sustainability considerations, but you'll find that their exclusions and their sort of inclusions and sort of rating methodologies that they incorporate will quite vary. But on the face of it, they might just be called UK equity ESG. So the ESG policy is really important to understand. I'd say introspection is actually probably a good place to start when it comes to ESG fund selection. Asking basic questions such as, what are my values and principles in order of preference? What matters the most? what do I definitely care about, and what are collateral benefits. Optimizing numerous parameters can be challenging, if not impossible. The analogy I like to use is that ESG fund selection is effectively like a cake. We can't have our cake and eat it, but we can choose parts of the cake that matter to us the most. And it's a matter of systematically prioritizing which ESG policies matter to us the most across risks and exposures.
So yes, I completely agree with your analogy. So long as the direction of travel for absolutely everything comes with us, over fairly short periods of time. I've spent trying to explain to people that stewardship strategies do make sense and that diversity makes sense because we've got to move everything in the right direction. So I really appreciate your pulling out the fact that diversity is a good thing, because you can have a more sustainable approach to any type of company, any sector, any business strategy. So yes, necessarily diverse is the word I use, and I'm really pleased to hear that MSCI is giving the same message. Thank you very much, Rumi. That's great.